Target stock price has fallen lately, and in this video I am going to do an in-depth analysis by looking at their income and cash flow statement, their balance sheet, their dividend, and finally using my Excel spreadsheet to see what price you should pay for Target stock. Let's start with their income statement and take a look at revenue growth. As you can see, year-over-year revenue growth percentage is not high because Target is not a growth company, except during COVID when they had very high numbers, but this was due because there were a lot of online sales and people were buying a lot. We can see this also in the chart that they've averaged between 1 and 4% over the years. Then COVID happened, but this is not normal, and now revenue has come back to normal. Moreover, if we take a look at what analysts are expecting for this company, we can see that for revenue growth, they are expecting between 1 and 5% over the next years. So I think it is clear that Target is not a growth company. This is not a Palantir that is going to grow massively over the next years. This is a well-established business that is going to grow probably between 1 and 5% over the next years. Now let's take a look at their net income, in which obviously something similar happened like revenue. In COVID, it was very high. They managed to make $7 billion, which for a company like Target, this is insane. As you can see, prior to COVID, they were making around $3 billion, and it is now sitting at $2.7 billion, so back to normal again. Now this is interesting. If we take a look at what analysts are expecting in terms of EPS, the profit of this company, right now they are making $5.98 shares, and they are expecting this company in 2027 to make $15 per share. This is almost tripling EPS. So this is very interesting, and if analysts are correct, this stock could have a lot of upside potential. In order to determine a buy point for Target, I'm going to use my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. And as always, I am going to do a 7-year analysis. Let me quickly explain my assumptions before I reveal the prices. Let's start with revenue growth. So we have seen that according to the history of this company and what analysts are expecting, that this company should grow between 1 and 5% over the next years. And this is exactly what I'm going to do. I'm going to put 1% on my low assumptions, 3% on the middle, and on my high assumptions 5%. Now let's take a look at their margins, and this includes profit margin and free cash flow margin. And let's take a look at the history of this company regarding margins. If we start with profit margin, even though it is now at 2.5%, they have averaged consistently for the past 8 years between 3 and 5%, except during COVID, in which they had a 6.5%, but I'm not going to take this into account. We have also seen that analysts are expecting EPS to skyrocket over the next years, but I'm going to be conservative, and because it's very consistent, I'm going to put 3%, 4%, and 5%. Then if we take a look at free cash flow, it is a bit more all over the place and not as consistent. And we have seen that they managed to do 6% during a lot of years. I'm not going to take COVID into account, and it is currently negative, but this is only temporarily. So I'm going to put 2% on my low assumptions, 4% on my middle assumptions, and 6% on my high assumptions, just because it's a bit more inconsistent. Then in terms of PE and price to free cash flow, the average of the stock market is around 15 usually. And you should assign a higher PE to great companies and high revenue companies. Target is not a high revenue company. However, I believe it is a great company and has a good moat. So I'm going to put 16, 17, and 18. Then for the discount rate, which is the return you want to get each year on your investment, as I always say, you can get around 8 or 9% investing in an ETF. So if you take the risk of investing in an individual stock, your rate of return should be higher. And as your assumptions get less probable, your rate of return should be higher also. So I'm going to put 10% on my low assumptions, middle 12%, and on my high assumptions 14%. Then for the shares outstanding, I'm going to leave it 0% and be conservative. So now let's reveal the prices. As you can see, according to my Excel spreadsheet, Target looks like it's trading at a pretty good valuation. If you believe the high assumptions, you would make a 20% return on your money each year, including their dividend, which is currently 3.3%. And let me show you how it is 20%, even higher. If I put here 21%, it takes the stock price around what it is today, which is $132 a share. Then, if you believe my middle assumptions, you would make around a 13% return on your money plus their dividend, which is also very, very good. However, if you believe the low assumptions, which include that Target only grows at a 1% rate, the stock price needs to fall more. Now, let's take a look at the balance sheet of this company. As I have explained in previous videos, the debt is essentially the difference between the market cap and the enterprise value. And we can see here that there is some debt, not a lot. However, this doesn't worry me at all because there is a lot of capital leases included in here. And Target is a well-established business that is not going to go under anytime soon. In conclusion, I believe Target is a great buy today, but please do your own research. Do not buy it just because I say buy it. I think it's trading at a cheap valuation for a well-established business. I don't think this is a company that you're going to get crazy results, but it's a good, consistent business, trading a bit undervalued. And also they pay a 3.3% dividend yield. So I hope you enjoyed the video. As always, do your own research, and I'll see you on the next one.